that whole sector is among the cheapest out there. No question about that. I'm concerned not only about a slowdown in the US, but more importantly, much more importantly for the commodity complex, will be a slowdown in China. So there's a real supply constraint with copper and with uranium to a different extent. Remember, silver has only just got back to the price it was at the end of the 1970s. And that's it. It's not its inflation-adjusted price.
Okay, ladies and gentlemen, so today we have Adrian Day back on the show. And today we will talk about the US economy, commodity sector, precious metals, and many other very interesting topics. So, sir, thank you so much for being here.
Well, thanks for having me, Vladislav. Good to see you again.
Yes. So, Adrian, so much happening in the economy with the precious metals and everything. So we have a lot of topics to cover. But I would like to start with the macro picture. So what's your take on what's happening with the US economy right now, and what would be some of the things that you are paying attention to?
Yeah, that's an interesting question because, I was just thinking about that when I was just sort of gathering my thoughts for this interview. And it's really strange how the US economy has suddenly completely dropped off the discussion. Nobody seems to be talking about the economy anymore. I mean, obviously, there's other things going on, both politically, geopolitically, and with the markets. I think part of that is probably, because of the government shutdown, we don't have economic stats. And so without the economic reports, people don't have too much to talk about. My sense is that the US economy is still slowing. It's not necessarily heading for a deep recession or anything like that, absent other things, happening. But it's definitely slowing, and the employment picture in particular is of great concern, I think, because even though, as we talked about last time, even though the sort of headline numbers are still reasonably under control, getting worse, but still not bad. Like the unemployment rate on the surface looks good. But under the surface, things are really not good in the employment picture. And I may have mentioned this last time, I don't know, but if you look at the last 12 months, now we don't have last month's numbers, but if you look at the last 12 months that we do have numbers for, apart from the fact that the government and the ADP, which is a private payroll report, have totally different numbers for new jobs. And apart from the fact that the BLS, Bureau of Labor Statistics, keeps revising their numbers in very, very significant ways. They have the first revision, then the second revision. So you really don't know even what the government thinks the numbers are until 3 months after, they're already 3 months late when you get the final picture of what the government thinks they are. And those revisions, the first and second month, are significant. They're not just minor little twitches. But in addition to that, you have these annual revisions. And last time it was over 900,000 jobs for the last 12 months. So they said, oops, we thought they were new jobs, but they weren't. But apart from all of that, which is significant in itself, if you look at the composition of the new jobs, over half of them, literally, are either government jobs or part-time jobs. And when you look at the part-time jobs, something like 3/4 of those are people who say they're working part-time because they couldn't find a full-time job. So they're not people working part-time out of choice. So I would argue that's not a healthy labor market. Not at all. And I won't go on and on and on, but you can look at other economic reports and come to the same conclusions that on the surface, things don't look too bad. Retail sales is still pretty good. But then credit card debt, is at a 20-year high. So if people are only, and credit card write-offs are now increasing. And so if people are only able to continue their spending because they're maxing out their credit cards, is that a healthy consumer? And again, I would argue no. So I think, I think the economy is definitely deteriorating, and that's why, that's why the Fed cut rates last month and probably will do so again this month. I mean, earlier, I must admit, I didn't think that we would see 3 rate cuts this year. I thought they would skip October, but increasingly it's looking, judging by Chairman Powell's comments the other day, it's looking as though that's definitely on the table. Let's put it that way.
Right, right. And so I would love to look even at the bigger picture. So on one side, Adrian, we have stock market that looks overvalued. We have the really high debt levels. But then on the other side, we have the monetary system that's very inflationary. So do you believe we could get deflation if we have a big downturn with the economy, stock market, but over the long term, still inflationary system?
I think over the long term and even the medium term, depending on how you define that, but if we get over the initial downturn, beyond that, I think it's definitely inflationary. And again, I'm not looking for sort of hyperinflation or anything like that, certainly not anytime soon. But again, just looking at the government's numbers, I won't bore everyone with getting into detail of why I don't think they're accurate. I think everybody knows just from personal experience, but they're underestimating, my personal inflation, your personal inflation. But even those numbers, the Fed, for the last really year and a half, has made killing inflation its number one goal. And yet after the, COVID spike back and then back down again, after the COVID spike, they have made killing inflation their number one goal, and yet it's still well above their target, their arbitrary target of 2%. It's also well above where inflation was or CPI numbers were for 5 years before COVID. So they certainly haven't succeeded in killing inflation. And I mean, the real key to that, of course, is we talk about increases in consumer prices being inflation. That's not inflation. That's, technically speaking, that's a result of inflation. That's a symptom of inflation. Inflation is when they inflate the money supply and credit. So so you can raise interest rates, you can do this, you can do that. But if for the last, I mean, really, since the great financial crisis, for the last 15 years or whatever that is, you have increased the money supply year after year after year beyond the needs of the economy. You will have difficulty controlling inflation because that money has to go somewhere. And recently, of course, since the great financial crisis, most of that money, because of the channels in which the Fed distributed it, essentially, if you like, or in popular parlance, to Wall Street, not to Main Street, but because of the channels in which the Fed distributed that extra money, then the stock market has done remarkably well. But that's really inflation. That's another symptom of inflation. It's going to the stock market rather than to goods and services. Anyway, long-winded answer, but I think this is a global issue as well, because most central banks around the world, as you know, have been cutting rates, and they've been cutting rates like the Fed before inflation is under control.
Just a very quick break, guys. So I've spent the last 12 months creating this course, Wealth Building Blueprint. I've put an unbelievable amount of effort into it. I cover investing, trading, speculating, business. The course is perfect for people who are still relatively new to this wealth building process. And I also offer 3 days money back guarantee. No questions asked. If there's absolutely anything that you're not happy with, you will get your money back. There's also a private community where you can ask me any questions, you can talk between each other, you can share news and things like that. The link will be in the description. Right now the course is at a 70% discount, and let's continue with the video. Some really, really good points, Adrian. So let's move on to the fun stuff, precious metals. So gold is at $4,200 per ounce right now, and silver is doing really well as well. But if you look at the big picture, Adrian, so the factors that moved gold to these levels, they're still here pretty much. But at these valuations, what is your view on the gold and silver markets?
Well, I'm still very bullish, but we have to recognize that after what's happened, in particularly since August, where gold has just, done a moonshot, as it were, gone way, way, way above trend. And the trend was already pretty sharp. One has to recognize that there's a potential for a pullback. So let me start by saying why I don't think we're at the top, why I don't think we're overvalued. I mean, first of all, if you look at gold itself, a physical metal, the physical asset, and you look at who's been buying that and why they've been buying it, and of course, primarily that's the central banks of the world, they have been buying it for reasons that are unrelated to the economy or economic environment, and they are very price inelastic buyers. They're buying it for defensive reasons, and so the price is not the determinant of when they buy. The Polish central bank doesn't look and say, 41.96.35. Think we'll wait a little bit. Oh my gosh, 41.85, let's buy. Then they're price inelastic. They buy, and I'm not just talking now about the Polish central bank. Central banks are buying, as we know, to diversify their assets away from heavy concentration on the dollar, because there's still half of their foreign reserves are in the dollar. Heavy concentration on the dollar, which is an asset of a fiscally irresponsible government. And I'm not talking about this government led by Mr. Trump. I'm talking about the US government over the last 30 years. And on top of that, we have the weaponization of the dollar. And so they want to diversify their assets in that environment. And if that's your objective, yeah, you'd rather buy a 2,000 and a 4,000, but you still want to buy. I use the analogy of flood insurance. If my house is in a floodplain, I'll shop for my insurance, but I won't say, little bit expensive this year. Let's wait till next year. I mean, you go ahead and buy it anyway. So, so I think that buying is going to continue. The question obviously is how much is enough. And central bank foreign reserves, the dollar is a percentage of central bank foreign reserves. And by foreign reserves, we mean, for the Bank of England, not the British pound, right, etc. Bank of Japan, not the yen. But so foreign reserves at the beginning of this century, 1999, it was about 78%. And it's been a steady decline for the last 25 years. 5 years ago, it was about 65%. Last year, it was 58%, according to the IMF. And according to the ECB, in August, it's now 48%. If you're worried about concentration of assets issued by a fiscally irresponsible government in the face of dollar weaponization, is 48% still too much to have? And I would argue for a lot of banks around the world, 48% is still too high. So I think that buying is going to continue. Anyway, that's just the central bank. So for all of those reasons, I don't think gold is overvalued. It's very difficult to value gold because you can't value gold in the same way that you value a manufacturing company, where you look at revenue and expenses and cash flow and dividend and book value. You can look at gold on an inflation adjusted basis. You can look at gold relative to all the debt in the world, gold relative to all the money supply. You know, you can look at all of these things. Gold relative to the Dow is a very popular way of looking at it. I mean, you have to look at it relative to something else. It's difficult to analyze gold itself as you can analyze, you know, Nestle, and say, you know, it's expensive on a book value. It's expensive on an earnings basis. It doesn't have earnings. But if you look at a gold versus a Dow, for example, it's definitely not as undervalued, no question. It's not as undervalued as it was 5 years ago. But on a 100-year basis, on a 50-year basis, it is still above the average valuation, and a long way from the point where the Dow gold ratio bottoms, right? And gold is at the top, like in 1980. So we're a long way from that, in my view, a long way. And gold stocks, the same thing. You know, gold stocks are still trading well below their long-term average valuations. And in fact, in some cases, on some metrics, they're trading pretty much at their lowest multiples ever. Don't forget, when the price of gold goes up, the value of the gold they have in the ground goes up, the value of their mines go up, and because the costs of mining have not gone up anywhere near as much as the price of gold, then the margins go up, and with the margins expanding, the cash flow goes up. And so the valuation metrics, even though the price of a stock has gone up, the valuation metrics haven't gone up anywhere near as much as the price of the stocks have gone up. So, yeah, and we can look at all sorts of other things. I mean, one of the ways to look at whether you're close to a top or not is sentiment. And sentiment is not, you know, you can't get out a piece of paper and a spreadsheet. It's a little more difficult to look at. I mean, obviously, you can look at volume and price and relative strength indices and things like that. And on those bases, you would say that the gold stocks are high, but not, you know, in a danger zone. And if you look at sentiment indicators, which can be everything. I mean, when you get into an Uber, does the driver pitch you on his latest gold stock? No. I mean, if you start talking to him about gold stocks, he turns the radio on. If you go to a dinner party, is everybody sitting around talking about their latest gold stock? No. So the sentiment, and then you look at hard numbers like the GDX flows. And in the last month, we've still got net outflows from the GDX in the last month. So on what I'm saying on balance is, and we could dig into this more if you want, but what I'm saying on balance is, I don't think gold and gold stocks are anywhere close to the top. Might we get a pullback? And if we get a pullback, would it be, you know, gut-wrenching? Probably. I mean, if gold retraced, let's say 50% of the move that it's done since August, which is not at all an unrealistic kind of thing, you know, that will put us back at around 3,700. If gold went to 3,700, the gold stocks would drop 40%. And that would be gut-wrenching. I see no sign that that's going to happen anytime soon. But as they say, they don't ring a bell at the top. But I mean, if gold can push through, even in the face of, you know, Gaza peace, we don't know how long it's going to last, and everybody is concerned about that. But nonetheless, you know, one might think, oh my gosh, peace in Gaza, maybe gold will drop. What did it do? It dropped $2 for 10 minutes. I exaggerate, but It just blew right through that. And I don't see any sign of this stopping anytime soon. I think it stops when the price just gets sort of too much for people to want to buy.
Yes,
Long.
that's a great analysis, Adrian. So I do get a little bit of pushback from the audience about, well, how do we know that the retail is not uh, is not is not interested in gold so far? So what would be some of the things that you would look at? Would it be gold as a percentage of portfolios? What would be the signs that would tell us that, okay, the retail in the West is actually into gold now?
No, good question. I mean, I think there's, other than the anecdotal evidence, like, people talking about gold, and we shouldn't dismiss that, because if you go back to 2000, for example, you were probably just a little kid at that time, right? Were you even alive at that time?
Oh, I was.
But if you go back to 2000 with the dot-com mania, I'm not kidding. Everybody was pitching you on their latest dot-com stock, including the Uber driver and the barista at Starbucks. It was something people talked about. So we shouldn't dismiss that kind of anecdotal evidence. It's the famous Joseph Kennedy, the grandfather of the current crew, and the shoeshine boy, right? When the shoeshine boy gave him a stock tip, he decided to sell all his stocks. Okay, so what can you look at? Well, first of all, you can look at flows into the GDX and other gold miner funds. So let me back off a second. I'm sorry. There's obviously someone buying gold stocks, and most of the buying is coming from either people who are already interested in gold and silver. But when I say gold, I'm talking gold and silver. People already interested in the asset, and it's coming from sophisticated investors, whether it's Ray Dalio or Gundlab or sophisticated investors who are buying. There seems very little evidence that is coming from what I'll call ordinary investors who are not gold specialists or gold bugs or whatever way you want to put it. And it's not coming from generalists, whether it's generalist funds, whether it's financial advisors who are allocating part of the assets to gold or anything like that. There's no evidence of that. So the flows is very important. When the dentist in Oklahoma calls his financial advisor at Schwab in New Jersey and says, I'm hearing a lot about gold. Don't you think we should have some gold? And the financial advisor says, how do you spell that again? Yeah, okay, we can put 2% into gold. What does he do? He doesn't buy Ajax Exploration or Consolidated Moose Pasture. He buys either Newmont or Barrick, or he buys the GDX, right? Or Schwab's own gold fund, but he buys the fund. So you can look at the flows into the fund. So that's where generalists go. That's where ordinary investors go. You and I, we don't buy the GDX. Your audience doesn't buy the GDX. We go around looking for our own, favorites. So that's definitely a big sign. There are surveys from time to time that come out from different people. Bank of America does one. Morgan Stanley does one. You just have to look for them when they come out. Showing UBS does one on the percentage of gold held by family offices. And the last one that came out, now admittedly that was June or July, showed less than 1% exposure to gold assets. And I would argue that, if anything, family offices would tend to be on the cutting edge of, they'll get into it before, the generalist mutual funds and the bigger institutions. They tend to be a little more nimble. Bank of America did a survey of financial advisors, an investment advisor, sorry, investment advisors, not financial advisors, asking what percentage of their clients' assets were in gold. And 78% said it was less than 1%. They didn't ask how many had zero. Unfortunately, I wish they had, but they just said less than 1%. And then they went from 1 to 2, and that was like 15%. And then over 2% was like, 3 people. So you can look for surveys like that. But all of the indications are that the generalist investor, the ordinary retail investor who's not a gold bug, all of the indications are that they are not in the sector. Now, I think there's a little bit of a turn. The GDX, as I say, has had net outflows in the last month even. That's outflows of about 100, it's over 100 million anyway. But the last week has been all net inflows. So has there been a turn? We'll have to wait to see what happens, over a longer period. But it's certainly not a flood. We can say that. It's certainly not a flood.
Yes, I fully agree with you, Adrian. And so we covered a lot on gold. With silver, would it be because I'm very aware that silver has slightly different characteristics than industrial demand as well. But when you're looking at it in the current environment, would you look at it as gold's younger brother or sister, or would you look at it completely separately?
No, to the largest extent, I would look at it as gold's, younger brother or sister. But those characteristics you talked about, particularly the supply characteristics, where there are no huge stockpiles, meaning you can't relieve the pressure on the price by stockpiles coming to market. Scrap is not anywhere near as plentiful as it was, let's say, in the 1970s and even in the early 2000s. And perhaps most significant on a long-term basis is you don't have is that the price signals from the price to the production are very, very tenuous. And we may have talked about this last time, but people need to realize that just as the demand for silver has different patterns than a demand for gold, so too does the supply. You've got basically 3/4 of silver supply, silver production rather, is byproduct. Some of it is byproduct of the gold mines, but a lot of it is byproduct of zinc mines or lead mines. And as I like to say, the lead miner in Bolivia, who's got 8% of his revenue coming from the silver byproduct, he doesn't build a new lead mine because the price of silver moves up, right? And so the production response up and down is really very tenuous to changes in the silver price. And that's why silver, for all those reasons, that's why silver can have those explosive moves, because there is no new supply to come on. And we're seeing now how they're struggling, people are struggling to sort of move gold around silver, to move silver around the world to meet obligations. But I think on at base, it is largely the same motives that drive the buying as drive gold. And as gold goes to 2,000, 3,000, 4,000, there are more and more people who say, well, instead of taking out a mortgage to buy 1 ounce of gold, why don't I buy, my math's not too good, but why don't I buy, 20 ounces of silver? So there's more people. So I think that's what's happening, yeah.
Yes, and that's likely why silver usually spikes near the end of the bull market as well, probably for those reasons as well.
Sure. And no, absolutely. But I don't think, for reasons I mentioned earlier, I don't think that means we're near the end of the bull market. Remember, silver has only just got back to the price it was in the 1919 at the end of the 1970s. And that's it. It's not its inflation adjusted price.
Yes, definitely. And Adrian, so we did talk about the economy, and I know that you are bullish on the commodities sector in general. But would you worry that the possibility of a recession or a slowdown could be negative for copper, uranium, and things like that?
No, absolutely. That's a really good question. So first of all, I'm bullish on the whole commodities complex. If you look at the commodity complex in general, again, relative to financial assets, relative to the Dow, it's pretty much at 100-year lows. It's just bounced off the 100-year low. So relative to equities, very, very, very inexpensive. So I'm bullish on the whole complex. I tend to favor those. So first of all, I tend to favor those where the real driver of prices is either supply shortages or potential supply shortages. Obviously, any price is set by a combination of supply and demand. But there are some commodities like iron ore, for example, where there's no shortage of iron ore deposits. If the price gets high enough, you can bring on new iron ore supply. Now, some of it is low grade. There's maybe more of a shortage of the higher grade, more environmentally friendly iron ore. But just in broad terms, if the price goes high enough, you can bring on more supply. Copper, not so much. So there's a real supply constraint with copper and with uranium to a different extent. And so I tend to focus on those. But to address your question in just very broad overarching terms, yes, it's concern about the global economy that makes me favor gold significantly above our other commodities. So in our resource accounts, for example, we would have about 45-50% in gold. And then you'd have another 15% in silver. Well, then you spread the rest among every other commodity. So you can see where I'm putting the money. I'm concerned not only about a slowdown in the US, but more importantly, much more importantly for the commodity complex will be a slowdown in China. And, the economic report that came out from China this morning shows, deflation gaining strength. Now, deflation is not the same as recession, as you know. You can have a, quote, good deflation, such as Britain had from 1815 to 1914, a whole century of deflation. And nobody's going to argue that the economy didn't grow over those 100 years. So deflation doesn't necessarily mean recession. But I think in the current context and the current context in China, it is a warning sign of a slowing economy. And if China's economy slows, forget about tariffs and everything else, then obviously the demand for most commodities is going to go down.
Right. And Adrian, so I spoke to Rick Rule very recently, and he's very interested in oil and natural gas, especially in Canada, because he believes that it's yes, he's worried about possibility of a recession, an economic slowdown, but he believes they're too cheap to ignore. What would your view be on that sector?
Yeah. Well, a few things. First of all, there's no question that the oil and gas stocks that whole sector is among the cheapest out there. No question about that. I think part of that has been driven by a false narrative, both the false narrative, well, three things really. US shale, which contributed overwhelmingly, US shale over the last 10 years was responsible for the growth in global production. Not most of the production, but most of the growth in production. And US shale, by every indicator, is rolling over. We've seen peak production in most of the big shale fields in the US. Now, they all have tails. Geologists tell me that the tails are probably shorter than they are for traditional oil fields. We'll find out, but most of them have peaked, and the numbers show you that. The second false narrative, I think, is that OPEC, and particularly the Arab countries, and particularly Saudi Arabia, have so much excess oil that they could ramp up the production anytime they want. And that would not seem to be the case. And along with that, you've got some of the really big fields, Mexico, North Sea, of course. Every so often you get these new fields that have, North Sea was a perfect example, that have these huge increases in production that affect the global price. And then, of course, they peak and they decline. So, but there's some of the big fields in the world. Mexico would be one that seem to be declining. And then, of course, you have the whole green narrative, and the narrative that the world is going to end carbon internal combustion engines, by 2030 or 2034. Or whatever various countries' targets are. And I think we're beginning to realize that this is not going to happen. This is not going to happen at all. So I think oil and gas are exceptionally out of favor. The sentiment is very weak. I think the supply demand is attractive, and the prices are attractive. Just to show how out of favor they are, you can go back maybe 15 years, and oil and gas represented over 15% of the S&P. Now it's around 2% of the S&P. So very out of favor. Now, I think, as I mentioned, my own view is that the move to ban internal combustion cars won't happen on schedule. It also appears that buying is shifting from electric vehicles to hybrids. And I used to think that for most people, the electric car was partly a status or a virtue signaling, but for most people, it was their second car. They had the electric car to go on trips of 20, 30, 40 miles, but for a real trip. Now, in Ireland, it's not quite so bad because it's a smaller country. In Britain, it's not, unless you want to go from Land's End to John O'Groats, you can do that. But in the US, if the Texas rancher goes from one end of his ranch to the other end, he needs to refuel. I'm exaggerating, but you know what I'm saying. Those trips. I mean, I know, for example, where my daughter went to college on the East Coast when I lived in Annapolis and she was in North Carolina. I could not do a round trip on one fill. I didn't have an electric car, but I calculated it. And so most buyers of electric vehicles would have two cars. as I put it, one for virtue signaling around town and one for real trips. And so you've run out of people, and that's a simplistic way of looking at it. You haven't obviously run out of people, but the number of people that can afford 2 cars is declining. And I think what we're going to see is more people buy hybrids. And the interesting thing about hybrids, I'm told, is that hybrids actually can be less efficient on certain parameters than an internal combustion engine, and they still use oil or gas. Gas if you're in America, petrol if you're in Britain. Do you call it petrol? Yeah. So you still have to fill up with petrol, and so anyway, long-winded answer. I don't think we're running out of the demand, and of course, you still need it for industry. So yeah, I mean, I'm turning. I was avoiding oil and gas in our resource accounts for the last 7 or 8 years, frankly. But I'm beginning we're beginning to buy some, mostly the E&P companies. Some of the pure exploration companies, you have to really look at their balance sheets, which Rick obviously does. But you want to make sure that they can actually survive if we have low prices for another year or two. But certainly the exploration, but also the E&P companies. Yeah. I would agree with that. But again, it's not as high a weighting as gold.
Great points, Adrian. Thank you so much for that. So I think, Adrian, we covered a lot. These are all the questions I had. Is there anything else that maybe we haven't mentioned that you would like to cover?
Well, the only thing I would say, we talked about gold and gold stocks, including silver, and how, they've obviously had a huge run up. I don't think it's the top, but, we could see a correction. So what I would caution people, particularly with the more speculative, the smaller companies, the more speculative companies, don't forget to take profits on those. And sometimes you have to take profits on the smaller companies when the volume's there, not necessarily depending on how much you own, but you have to do it when there's a lot of volume, not just wait for the peak price. So, and I would also say for people who are getting into the market now, because I know there's a lot of those people who are just getting into the market now. Absolutely, I would buy. No question about that. I think a year from now, 2 years from now, prices are going to be much, much higher. But keep something in reserve in cash, either for a market pullback or just for pullbacks in individual stocks, which happen all the time for various reasons. A good example would be Orla last month, Orla, which is a sort of intermediate producer with 2 mines and 1 development project. But I looked at the company, I met with the management, I analyzed it, liked it, but just thought it was too expensive. And then Newmont decided to sell all of the shares that they owned in an overnight offering, obviously at a discount to the market. And what always happens with the overnight offerings is, the stock price opens up where the offering is. And it's because owners will sell their shares in order to buy the discounted shares or whatever. And as normally happens, the market price actually trades below that price. And that's exactly what we saw with Orla. Just as an example. So there's always not just, you don't have to have a big market correction. You just have to have corrections in individual stocks for various reasons. So always have some cash kept back in reserve is what I would suggest.
Yes, 100%. I was actually feeling way more comfortable, Adrian, when my portfolio was red and I was dollar cost averaging for years into gold and silver. And now, when it's completely opposite and you have to sell, it feels very, very uncomfortable in a way, but it's a good problem to have.
Yeah, no, absolutely. I said this to someone yesterday, 10 years ago, it was so much easier to manage money because I looked and things were cheap and I was comfortable buying them. Now it's a lot more difficult. Do you buy at these prices? Do you sell and miss the upside? Because let's face it, there were people who were saying you should sell at 3,500 and even 2,500 and look at what you would have missed. So it's a lot more difficult now.
Yes, definitely. So, Adrian, again, thank you so much for your time. Really enjoyed the conversation, and I'm happy. I would love to have you back on the show.
Yeah, no, thank you very much for having me. I enjoy our conversations. Thank you.